it is essential that you know everything that's in the pre-reading. Why? Because this reading is 18 pages in the PDF of the curriculum, and it covers 3 LOSs, and every single one of those LOSs is in the pre-reads. All this section actually does, all Learning Module 6 does, is recover those 3 LOSs from the pre-reading and goes through all the examples that have already been gone through in the pre-read. So we're going to treat this just as a review, a high-level review of those 3 LOSs. Shouldn't take us long at all. If you want to do all of the walkthroughs, all of the examples, then go back and have a look at the pre-read. If you've already seen the pre-read, that's great. And just treat this, as I say, as a quick review. And we'll just calculate some ratios in the middle just to bring it to life a little bit. With that said, let's hit LOS 1, the first one we're going to look at, which is this. Describe the measurement of inventory at the lower of cost and net realizable value and its implications for financial statements and ratios. As I say, we'll focus on the ratios because that's the entertaining bit. The rules themselves you've already seen. Let's recap them. First of all, IFRS. IFRS states that you should value inventory at the lower. We're looking at worst case scenario here. That's what accountants like to do most of the time. Lower of cost and net realizable value, which you'll see written down in the curriculum often as NRV. That means if NRV is less than cost, we bring our inventory onto the balance sheet at cost, everything we spend, getting it into its current location and condition. We bring it in at cost. Then, if NRV is lower, we have to write it down. So imagine it cost 1,000. There's your cost. We decide that the NRV is only 800. That is lower. You have a write down of 200. It is charged to the income statement. Inventory is reduced. Cost of goods sold is usually where you would hit the income statement. US GAAP requires that. Doesn't mention it in IFRS, but you'd expect to see it in cost of sales. Which means all of our margins, all of our profitability ratios get hit because assets are lower. Any ratio with assets or equity in is also going to get hit. Going forward, subsequent increases in NRV. So if this inventory recovers, okay, it's jumped back up again, let's say to 1,500, will be recognized under IFRS, and cost of sales in the income statement in that period will be reduced. It's a reversal. Now be careful, you can only reverse it back up to cost. So even if it pops back up to 1,500, you can only write it back up to its initial cost that was recorded. Under US GAAP, if you're using any cost flow assumption for your inventory other than LIFO or retail inventory, it's exactly the same as IFRS, except no reversals. Hence, a write down under US GAAP is permanent. Once it's written down, it's written down. If you're using LIFO or the retail inventory method, slight difference, it's lower of cost or market value. Market value is defined as current replacement cost with limits. That current replacement cost cannot be greater than the NRV and cannot be lower than the NRV minus the company's normal profit margin. It has to be within that range. Exception under both: agricultural products, forest products, minerals and mineral products, and commodity broker traders. All of those are exceptions in that the inventory can be carried at fair value. Makes sense. These things are traded. You can see their prices on a daily basis. You can put them in at fair value and movements go to the income statement. So that's a quick review of what you've already seen in the pre-read. If you haven't, as I say, go back there if you want to walk through it in some more detail. But what we'll do is move on and focus on the ratio analysis, the impact of write-downs. Don't try and learn every single ratio and every single impact. You'll be there forever, and then the examiner will come up with the one that you didn't bother writing down. Instead, learn the logic. What happens when we write down inventory? We reduce inventory on the balance sheet, which means current assets and total assets are reduced. That write-down, as we said, is charged to the income statement. So you increase expenses, net income, and therefore equity get hit. It is less likely you'll see this if the firm is using LIFO. Last in, first out. Most recent items have gone to cost of goods sold. The oldest items are therefore on the balance sheet. And in our normal situation of increasing prices over time, that means inventory on the balance sheet is at the lower, older prices. If it's at lower prices, less likely to need a write-down. But if we do have a write-down, what's the impact on our ratios? Solvency, first of all. Your classic solvency ratio, debt to equity. There are 4 you need, but whenever you're asked what's the impact on solvency, the quickest and easiest go-to to think about is debt over equity. There is a negative effect. Why? Because of the decrease in equity. We hit net income, we therefore hit equity. Debt stays where it is. Equity is reduced. Numerator is constant, denominator has been reduced. That means this ratio is going to go up. That, for a solvency ratio, we call a negative effect. Higher debt to equity means higher leverage, more financial risk. Liquidity ratios. Got to be a little bit careful here. The one I'm thinking of, the easiest to look at, is just current assets divided by current liabilities. If we're looking at that basic current ratio, negative effect. Why? Decrease in current assets. Current assets has reduced because of the reduction in inventory. Denominator isn't touched, numerator is falling, therefore this ratio will fall. Lower liquidity ratio is a negative effect. Now the only thing we've got to be a little bit careful of is that we're not being asked about the quick or the cash ratio, because neither of those include inventory. So yes, the current ratio will fall, but if you're asked specifically about quick and cash, it won't move. What about profitability ratios? Let's just think in the income statement, really simple. Your net margin, net profit, net income over revenue. Really straightforward again, not touched revenue. We're affecting expenses, costs here, because cost of sales is going up, net income is being hit. Numerator falling, denominator staying where it is. That decreases. That again is a negative effect on a profitability ratio. And finally, activity, probably the most entertaining to look at. Let's think inventory turnover. Cost of goods sold divided by average inventory. When we've got an income statement figure and a balance sheet figure, CFA curriculum likes to use the average balance sheet figure. What happens to inventory turnover here? COGS is increasing because we've charged that write-down, and typically it will go to COGS. Average inventory is decreasing because we've reduced inventory. So we have a double hit here. Numerator is going up, denominator is going down. That is 2 votes for an increase. An increase has a positive, or we describe as a positive effect. Why? Well, this ratio we're looking at is inventory turnover. How many times have you turned your inventory over during the year? It's how fast you manage to sell everything in your warehouse. The higher that is, the more you're turning it over, the more you're going through your cash operating cycle. It's good news. So be careful as an analyst. You look at a set of accounts, inventory turnover compared to competitors looks excellent. Just check in the disclosures, it's not due to a big write-down. So that's an overview, a summary of the impact on ratios. Let's see in action. We have here just a made-up set of accounts, balance sheet and income statement. You can see 2023, most recent year, and 2022. So we're going that way, and the average to help us with any ratios that need an average. And at the bottom, we've calculated a whole host of ratios. So profitability, return on equity, debt to equity leverage, current ratio for liquidity, Gross and net margin we have for profitability, and inventory turnover and days of inventory on hand, our activity ratios. And they've been calculated for you there as reported. So just to check one, let's look at ROE. Net income, 11,300. Divided by average total equity. From the balance sheet, average total equity 113,650, 11,300 over 113,650, as reported 9.94%. So feel free to pause the video and just go through, make sure you can calculate all of these, you know where the numbers come from. Only thing to point out for days of inventory on hand, it's the number of days in the period. We're assuming here 365. Now, let's write down inventory. Let's say we have a write down of 8,000. What happens? Keep your eye on inventory at the end of 2023 and COGS in the income statement. That inventory of 58 should drop by 8 down to 50, and that 8,000 should be charged to cost of goods sold, which will rise to 430,500. Kaboom. Now, obviously, it affects inventory in the balance sheet. There it is, which means current assets have been hit, total assets have been hit, net assets and equity, all reduced, as is net income, hence retained earnings. Cost of goods sold went up, gross profit is down, operating profit is down, profit before tax is down. Assumed here, the tax authorities are not interested in our write down, they're not allowing it as a deduction, so we've got the same tax charge, 3,300 net income. Now, just to help with the comparison, let's bring up what it looked like before we put that write down through. So there are our initial figures as reported, so you can directly compare. Obviously, it's not the full 8,000 difference here because this is average from the start and the end of the year, but everything in red shows you a fall in the balance, a reduction in inventory, current assets, total assets, net assets, retained earnings and equity. And in the income statement, an increase in COGS, meaning a drop in gross profit, operating profit, profit before tax, and net income, as we say. What did it do to the ratios? Well, let's just check what we said on the prior screen was not a lie. ROE, what happened? It's in red because it crashed. Net income reduced, but average total equity also reduced. So you might say, whoa, what's going on there, Richie? Why did that ROE not stay where it was? The reason is that net income is smaller than equity. Because net income is smaller, if you change both net income and equity by the same absolute amount, it has a much bigger proportional impact on net income. Hence, that ratio will fall. Let's just check it's right. Net income has crashed down to only 3,300. Average equity has dropped to 109,650. 3,300 over 109,650, 3.01%. So if you are asked about ROE, don't be fooled into thinking, both got hit. It doesn't change. Unless net income was the same as average total equity, which is phenomenally unlikely. If you think about it, net income is one drop into the pond of retained earnings, which is part of the ocean of equity. So net income in a normal set of accounts should be smaller than average total equity. Debt to equity, it's in blue because it went up. But remember, that is a negative effect. We increased debt to equity. It makes you think more financial risk. Current ratio dropped because of that drop in average inventory. Inventory turnover, here's our activity ratio. Inventory turnover went up. We are turning over our inventory more frequently. So that's a positive impact. Compare it to days of inventory on hand, which is the days in period over inventory turnover. That dropped. That is also a positive effect on an activity ratio because it's how many days of inventory you're storing. The smaller that figure is, obviously, the higher your turnover. So both of these, even though they're going in opposite directions, are positive impacts. And we can see from the income statement, fairly obvious because revenue wasn't hit, but profits were, that our margins have decreased. So that's a nice summary. And that's the kind of thing I would do if I'm practicing ratios. Just think of the impact on every balance and then go through the logic. What happened to the numerator? What happened to the denominator? Then work out what's happened to the ratio. Next, LOS, also covered in the pre-reads. Calculate and explain how inflation and deflation of inventory costs affect the financial statements and ratios of companies that use different inventory valuation methods. So we are talking here FIFO versus LIFO. Weighted average doesn't get much of a mention because it just sits in the middle. So let's review again what the rules are, what the impacts are, how the cost of inventory and the cost of goods sold is impacted. Well, LIFO, FIFO, all it's doing is telling you how the cost of inventory was allocated between the inventory figure on the balance sheet and cost of goods sold on the income statement. Let's say, and obviously it does depend on the accounting method used, let's say we use FIFO. First in, first out. And again, can't stress highly enough, if this isn't making sense to you and you're thinking, Richard, you're assuming knowledge here. Go back to the pre-read. That's where we go through all of the examples, a whole set of accounts for Volvo, all the examples on FIFO, LIFO, and so on. So first in, first out. The oldest units are in the income statement. The newest are in the balance sheet. LIFO is last in, first out. Newest units go through the income statement. The oldest stay in the balance sheet. Very, very quick example. Let's say on the 1st of Jan, we purchased 100 units at $50. That's $5,000 worth. And on the 1st of June, 200 at $60. That's $12,000 worth. And we sold 100 units. If it's FIFO, into cost of goods sold will go first in, first out, sold 100, 100 at 50, $5,000. This was 300 purchases in total. We sold 100. We've got 200 left on the balance sheet in inventory. Well, those 100 went, so it's the 200 at 60, it's 12,000. 12,000 stays on the balance sheet. 5,000 is an expense in the income statement. LIFO, sold 100 units. Newest units go to the income statement. So for LIFO, we'll sell 100 of the most recent. So COGS will take 100 at 60, 6,000. Inventory on the balance sheet will be the remaining 100 from June. So 6,000 plus the 100 at 55. 11,000 stays on the balance sheet. 6,000 went to the income statement. That is as complex an example as you need in your head to remember every single impact of LIFO versus FIFO. What does it do? Under FIFO with inflation, the normal situation, rising input prices, that's exactly what we had here, 50 in January, 60 in June. So that's this example here with rising input prices. What happens? FIFO gives you higher profit. Why? Lower COGS. First in, the older units hit the income statement. Older, cheaper if prices are rising. Lower COGS, higher profit. Higher inventory on the balance sheet. Under FIFO, the newest units are in the balance sheet. The most expensive if prices are rising, higher inventory. Obviously, LIFO is the opposite, lower profit and lower inventory. And when we're saying higher and lower, here we're talking comparisons, FIFO versus LIFO. Now, this is an interesting point. We ignored this with a write-down. We said taxes were not impacted. Taxes are impacted by your choice of accounting method for inventory. The tax authorities will listen to you. If you tell them you're doing FIFO, they'll calculate your taxes based on FIFO. And if we have a higher profit, we have higher taxes. So you'll either have a higher tax due on your balance sheet, tax payable, or you may have paid out more in cash. You may have hurt CFO. Lower profits for LIFO means lower taxes and hence a lower tax payable or higher CFO compared to a FIFO company that paid it. And that's it. To be honest, then, going into the ratio impact is exactly the same exercise as we just looked at for write-downs. Think what happens with a write-down. You're increasing cost of goods sold and reducing profit and reducing inventory. So every ratio impact we just went through, you can think of that as LIFO versus FIFO. If you had falling input prices, deflation, just reverse all of this. If you want to walk through a big set of accounts showing all of this, as I say, it's all in the pre-read video. And finally, describe the presentation and disclosures relating to inventories and explain issues that analysts should consider when examining a company's inventory disclosures and other sources of information. Not going to spend much time on this at all because it's a list of disclosures. It's not that much fun. And again, it's all been addressed in the pre-reads. If you feel like you want to read or watch a video about disclosures, then go back to the pre-reads. Here's a list. Let's just go through it because there's obviously two parts to the LOS. List out the disclosures and what issues you should be aware of. So let's have a look at them. The accounting policy adopted. Hopefully fairly obvious why you should pay attention to that as an analyst. One company may be LIFO, one may be FIFO. It's only going to be LIFO if it's US GAAP. IFRS doesn't allow it, but if you're in IFRS disclosures and they tell you they've used FIFO, if you then go to US GAAP, they will have the same disclosure. They'll tell you if they've used LIFO, you're going to have to adjust the accounts. If you go through the pre-read, there's a big section telling you how you can use the disclosures to jump between LIFO and FIFO. Total carrying amount broken down by merchandise, raw materials, production supplies, WIP, and finished goods, WIP being work in progress. Why might that be interesting? It'll give you some idea about where a buildup in inventory came from. As a very basic example, let's say your buildup in inventory comes from finished goods. That would beg the question, why are we not selling finished goods? That's an issue, potentially. Remember, all financial statements do is raise questions. Don't give you the answers, but we'd have to find out why. I'd be less concerned if finished goods was pretty constant and raw materials and WIP was building up. That would suggest to me we can see an increased demand on the horizon and we're positioning ourselves for it. That would be okay. Carrying amount of inventories held at fair value, less cost to sell, might be the exception that we're using for things like agriculture, etc. Or we might need to look at that as evidence of some assets that have been written down. Amount of inventories recognized as an expense. In COGS, amount of write-downs during the period. Useful information clearly to see if the value of our inventory is falling. Look at this one. Amount of any reversal of write-downs recognized as a reduction in cost of sales in the period. US GAAP at the bottom of the screen here says it's as above, except they do not require disclosures on reversals. Why not? Well, they are not allowed. A write-down under US GAAP is permanent. The circumstances that led to the reversal, that's useful because if the inventory is falling in value, we'd like to know why. How big an issue is it? And carrying amount of inventories pledged as security for liabilities be helpful if you were doing some sort of credit assessment, the loans they've got outstanding, the collateral they're using, and so on. US GAAP don't need disclosures on reversals because they're not allowed. You do need significant estimates applicable to inventories, that's helpful, and material income resulting from a LIFO liquidation. Why is that not required under IFRS? Well, that's not allowed. Under IFRS, you cannot use LIFO. LIFO liquidation, you sell old stock, you run down your inventory balances and potentially out of date, really old costs flow into your cost of sales figure, boosting net income. If that doesn't sound familiar or make sense, again, go to the pre-read. It is all in there. And that's it. I said it was going to be a nice high-level overview. The biggest thing to take away from here is A, if any of that sounded unfamiliar, you need to go back to the pre-reads. And B, focus on the entertainment here, the impact on the accounts, the impact on ratios of rising versus falling prices with LIFO versus FIFO, and the impact of write-downs.